Today, we're going to have a look at inflation and see if the inflation backdrop has truly changed. Are we back to longer term, lower levels of inflation? Or is there a risk of a surprise in 2024 to inflation ticking back up to the upside? This is going to be our core focus today. And then today's Trading Takeout is going to be how to construct a flowchart in your mind of how data can affect markets. But before we get started, make sure you hit subscribe so that I pop up in your YouTube feed every single day with the best market information, tips, and tricks to be able to increase your edge. Inflation, the big scary word that has terrified markets over the last couple of years. I think since the pandemic, we've seen a completely different market shift in terms of anything that we've seen previously, in terms of debt expanding at such a rate to finance the spending over the pandemic, to liquefy markets and to prevent bank runs. But we are returning back to near enough target. I mean, if we look at the US inflation rate, 3.1%. Their target is roughly 2%. The Bank of England's is 2% plus or minus 1%, which means that they can be at 3% or they can be at 1%. If they go beyond these, then the governor of the Bank of England has to write to the chancellor explaining the issues with inflation and explaining what they're going to do to rectify it. But in the US is naturally the one that we focus on mainly. Largest economy, dominates the world of the dollar. And so any change in monetary policy or any change in something that might affect monetary policy like inflation will cause rifts across the world and cause other central banks to change what they might be doing. But the one thing that I'm terrified of here is, yeah, fine, inflation's coming down. But if we go back to the 70s, okay, what we saw was a massive initial spike in inflation. So we saw inflation go from about 2.6% all the way up to 12.3%. Then we came back down to, let's call it 5%, roughly 4.9%. But then that was the bottom for about a decade. It wasn't until, let's have a look, 1982, okay, not a decade, maybe 8 years or something, 1982, that it returned to the same level, which is definitely concerning and something that I'm worried about right now, actually, because we've already seen in Europe some inflation measures tick back up. We haven't necessarily seen the same thing occur in the US, which is naturally a good thing. But I feel like there is definitely a broad-based risk where everyone is starting to price in rate cuts. There's a risk that inflation starts just drifting up a little bit, which creates a self-fulfilling prophecy. Sorry, I was just looking for producer prices, but it's not coming up. A self-fulfilling prophecy whereby prices then start increasing based on the expectations that, they will increase more in the future. And then you get an upward sort of drift or an upward spiral of prices just going up and up and up because people are betting on higher prices in the future. In the UK, we've seen that the Ofgem, the energy supplier, has actually increased the energy price cap as a response to, I don't know what, because energy prices are down. But we can slowly maybe make a small case right now that people aren't completely convinced that inflation is done. And that is a massive asymmetrical risk. So when you're looking at massive punts on the market, you're looking at home run trades, which you might hold for 6 months or so. They have a very small chance of coming off, but the risk way outweighs the probability. The reward way outweighs the probability of the win here. So you might have a really, really small reward, a really, really small chance of the trade coming off, but because it could mean, say, a return to all-time highs or something like that, it's a trade worth taking. And this is how you got to start thinking of markets. It's not, okay, well, here's, a place where risk looks sort of weighed in the favor of reward versus the risk based on some chart pattern, you've got to be saying, okay, well, if these factors come off, is it worth having a small position because I could get 200% on this trade? And this is kind of how I balance my book, if you like. I look at things from a perspective of, okay, there's a couple of things I can do to tick along and just see if I can have a punt here and there. I don't really intraday trade at all. But over the longer term, what I'm looking for are the opportunities that might sound insane. And this is the truth. They might sound insane, but if you are able to get one to come off, it makes up, say, 60% of your P&L a year. In my view, that's the best way to do things. But you have to have quite a fair amount of experience to be able to understand and subconsciously decide what the best course of action is, basically. So that's really how I look at things. And this inflation ticking up topic is probably one of those examples. How you would position for this is a tricky one. Would you position it short bonds? Maybe. Would you position it long gold? Perhaps. You know, you could look at that real rate trade collapse. But there doesn't seem to be that enough of a risk to reward just yet for that to come off. So interest rates are priced for mid-2024 to start getting cut. I think the prime time to see if there is a chance of this big reoccurrence of the inflation theme, the key way to justify whether there is any valid trade there is to look maybe March or April. So I'm telling you now so that there's preparation. And please bear in mind that this is a very, very low probability theme, since the market is currently pricing cuts. Okay, it's our job maybe to look at secondary and third data points to see whether there is any building on this thing, right? So please just get it into your head that this is not, I'm not saying, oh yeah, inflation's coming up. I'm saying this is a minimal probability theme, but if it were to come off, the fact that it would absolutely destroy all positioning, people are positioned for rate cuts, people are positioned for inflation returning to normal, would destroy all positioning, which means that it would lead to a massive reward relative to the risk and relative to the probability of it coming off. There might be better opportunities out there right now, but this would be one that I would keep my eye on as a boxing off of the potential themes that are coming up, if that makes sense. So I like to box things off as, okay, what's outlandish, what is consensus, and what is not so much the opposite of outlandish, but what is perhaps going the other way. So what might deflation look like, for example? So it's key to have those things cemented in your mind, so you can almost have like a little ticker that goes across, and this is what your decision on the market is currently. Maybe write these things down, actually. Maybe have like a little chart that says, okay, well, here's where I'm positioned right now. Am I in deflation or inflation camp? Where am I versus 2 weeks ago or a month ago or something like that? It's important to track these things in your head just so you can refocus and see where you're going to take your information from, what information matters more, what information you can prioritize, and then adjust your position and size, adjust your views based off of that. But my overall strong view is that we do, in fact, return to normal. The thing that we have to remember is markets are completely irrational. Macro views are there purely to provide some form of probabilistic, I guess, intent. It's not to say that, oh yeah, here's a price target or anything like that. It's to say, okay, well, if these factors were to happen, then, I've mentioned if then last week, then the likelihood of XYZ, increasing in value changes or decreases or whatever. So it's never to put, I think this is going to happen. It's to say, I think if this were to happen, then something else is more or less likely to occur. Never certainties, always changes in probability. And those changes in probability tend to be quite small. But you only need a small change to say, okay, well, that's just increased the chance by quite actually a lot. I just really wanted to reinforce something that I'd mentioned last week with regards to understanding data and how to process data in your own mind to come to an actionable trading idea. Now, the way that I think of things in my head when I see data coming through on the terminal or, on Bloomberg or whatever it is, I'm constantly thinking of what that data point has the greatest effect on next. Okay, and I'm not talking about necessarily what's going on right now. I'm thinking, okay, next week, next month, next quarter, how is this data point affecting something? So I keep mentioning if, then. If you go back to your physics classes in, year 11, or for me, it was fifth form, there were, or maybe even earlier than that, there were things called logic gates. Now, logic gates are a fantastic mental tool. And I sort of spoke about mental models last week in one of the Trading Takeouts, but they're a fantastic mental tool because they enable you to really, really think in your head of these different phrases that you can quickly go and break down information with and almost create a picture or flowchart in your mind. So let's take the German industrial production data today. Negative 0.7% month on month. The expected was 0.1%. So we take the negative 0.7%. It was worse than the estimated number. So what does that mean? Okay. If the industrial production data is poor and German GDP is made up of a lot of manufacturing, a lot of industrial activity, then that means because the DAX is also made up of a lot of foreign activity, then that means that German GDP is likely to wane, but also it shows that there's lack of demand externally. Okay. What does that mean? Perhaps the DAX is now a concentrated bet to look at downside on. Okay. Because the DAX is made up of 15% of foreign entities, okay, or foreign business, I should say, sorry. Let me rephrase that. The DAX is made up of 15% of domestic activity. Okay. Most of the business is done externally. So that means that global demand is waning if industrial production in Germany is faltering on a month-on-month basis. There's just loads of different ways in which you should and can construct these different ways to get to a view on a specific market, but you should always be fitting the data to the asset class, not the other way around. So don't just predominantly trade the DAX and then try and fit certain data points to it. You look at the data and then say, okay, what's the best expression of this view of this data? That's the best way to work it out. It takes a lot of effort, it takes a lot of understanding of multiple different products. But once you start to get to grips with, this is how bonds interact with FX, this is how the DAX currently, because things change, the context of the DAX currently is positioned and it's very sensitive to this kind of data. These are the kind of things that you really need to get to grips with, and it will just help generally with understanding the world as well.